Welcome back to 15 Minutes of Finance. This is the tax plan where I help you keep more of your money. Today's topic is real estate, and specifically within the context of real estate, the issue of selling real estate, whether that be your investment properties, your personal residence. There are numerous kind of tax planning tools, investment tools on how to maximize your tax returns or your tax savings given these various scenarios. And it gets pretty complicated. So let me just say up front that this episode will be a little bit of a deep dive. I'm not going to be into, incredibly complex things that'll take an hour and a half to explain, but we will go over some concepts that can get pretty complicated. So there are a lot of things that you can take away. There are also a lot of things we'll talk about that you still will want a professional to assist you with. Probably in some of these cases, even a mix of an investing professional to talk about your returns, a tax professional to map out your tax savings, and a real estate professional to map out what the actual real estate decisions that you're going to make are. So this is not necessarily a listen to this and then go sell your home tomorrow, but it will give you a lot of understanding and tools on understanding the world of investing in, selling, and transferring real estate. So let's get into it. So let's first kind of talk about some of the drivers of this world, this incentive of selling your property. Why do you sometimes want to sell or transfer or whatever, various investment properties that you might hold? So in terms of real estate investing, if we don't talk about for a second our personal residence, we talk about investment real estate, whether that's rental, commercial versus residential. There are a couple major deductions that you're taking for that real estate. Okay, so let's say that you invest in a 4-home or 4-family condominium, right? And your each resident or each family is paying $2,500 in rent. So you're projecting that brings in $10,000 of revenue per month, right? So now we talk about what those deductions are. The biggest one, and we've touched about this a little bit in the home office deduction for business owners last week, is depreciation. And so what that means is, let's say I buy that condominium for $1.5 million. I don't just take a $1.5 million deduction and, hey, look, I get a great return because I had $120,000 in income and $1.5 million in expenses. That's not how it works. So how depreciation works is based on the type of property, the value of the property based on what you paid for it is depreciated over that life of that specific property. Okay. So, in the case of non-residential commercial property, which would be like a plot of land that gas stations are on, or a strip mall, or, something along those lines, all of those buildings, okay, that are depreciated, that's a 39-year life. So without getting into any extra complexities of potential bonus depreciation or whatever, that means you take 1/39th of that in the example we used, $1.5 million, and that 1/39th of $1.5 million is your depreciation deduction each year. Now, on top of that, the other deductions you're taking are interest on the mortgage, and that's true of a home or a non-residential type of investment. You have real estate taxes potentially, and then you have all the other things that go into the actual business side of it that may or may not apply to you. You might have a property manager, and you might be deducting their management fee or their commission when they find new tenants. You might have cleaners and maintenance people. You might have insurance, right? All of those things are deductible, but the big one, the value of the property, it is depreciated, and that's how you get a deduction for it. And then this concept, I hope it makes sense because it will be very applicable as we shift into the sales side and the actual topic of what is the best way to sell my property or transfer my property. This concept of sell price, but then also factoring in depreciation we've taken so far, very, very important. Okay, so those are the main deductions on real estate outside of like the actual business side of things. It's going to be the depreciation on the value, the mortgage interest, not the mortgage payment overall. It's only the mortgage interest because the principal payment is already being factored into the depreciation, right? We can't buy something for $1 million then we're paying it back over time. We're deducting the principal as we're paying that. And then we're also taking depreciation on the principal because now we're double deducting the principal, right? So we can deduct in the year paid the interest and then the value of the property multiplied by whatever depreciation percentage. That's the deduction we get on the principal. It's not the principal payments that we're paying the person holding the mortgage. Okay. So that's how principal ends up in a sort of roundabout way being deducted. Okay. There's other tax considerations when we talk about maximizing real estate deductions, and I'm sure down the road we'll have a managing real estate episode on all how to maximize deductions. There's people who have each property they own in a separate LLC for both tax and liability reasons. They might have all of those individual properties or even those individual LLCs owned by a parent S corporation so that they can qualify for the terminology of being an active real estate investor or even real estate as business. There's various hour thresholds you have to meet so that you're considered a real estate investing professional, and then it's active income rather than passive income. There's all sorts of complicated kind of situations and potential things to take advantage of. We're not going to get super deep into the management side of things today, but just understand if you're in real estate, you want to know how to manage real estate better. It's definitely worth a conversation with your CPA or a new CPA if you don't have one. So let's talk about your options to sell real estate, and that's really the point of this topic today. And I'll just say you have me at my kind of best at this point, so to speak, in my top shape, because we've like recently, me and my business partner James, who's on all of our 2 Gents 2 Cents and 15 Minutes of Finance Friday episodes. So we've talked to multiple clients recently who are, their central question is, look, this is all the holdings I have in real estate. What are my options? Okay. So we've been doing a lot of research into this, and I feel pretty competent on kind of what I'm going to be talking about today, in terms of the options for people who own real estate. So let's talk about inheriting real estate, because the reality of it is, if you're a listener remotely close to my age of 31, there's a good chance, not to say you didn't work hard and buy your own home, there's a good chance you got your home from an inheritance from your parents, or maybe even you live somewhere that is technically still under the name of your parents or grandparents. And the reality of it is, we're at the precipice of one of the largest transfers of wealth, maybe the largest transfer of wealth generationally in recorded human history. Not only is kind of the growth of both real estate and stocks from the last 40 to 50 years astronomical, and so people with even moderate wealth who were smart potentially have a lot of wealth now, so there's that element to it. There's also the element where data suggests that boomers are not spending money at the same rate in retirement that other generations have. So that leads to the potential of higher inheritances due to, a perceived notion of the economy isn't as good as it was. I need to leave more behind than my parents did. So there's a lot of factors contributing to the bottom line that there's going to be a lot of inherited property over the next now to 20 years. Okay, so a lot of people are going to be in this boat. So if you have inherited property, there's something really important to understand, and this varies by state. So I'm going to explain what the difference is, and then I'll tell you how it is in California, but you might be in a state where it's the opposite. California has what's considered a step up in basis for inherited property. Here's what that means. Let's talk about that earlier scenario, right, where I bought a condominium for $1.5 million. Let's say I bought it 40 years ago. Well, the depreciable life is 39 years, as we just talked about, right? So after 40 years, I have fully deducted the value of $1.5 million that I paid for that condo. So there's no deduction anymore, right? And now I'm paying a lot more in taxes because I still have that $10,000 in rental income coming in every month, but there's very little offsetting expenses. The mortgage is paid, so there's no interest. I still have real estate taxes and, a manager of the property who gets, 5% of the revenue, but, do the math, that's not going to offset $120,000 in income. So if you are in a state without a step up in basis and you inherit that condo from your parents when they pass, you still have a basis of $0 in that property. Basis being calculated by the price you paid minus depreciation taken on it. So in the case where it's halfway through the life, you might have a $750,000 basis because you've been depreciating it for roughly 20 years. And so now the price you paid is $1.5 million. You've taken about $750,000 total in depreciation through the years. And now, you have a $750,000 basis left. What California and a lot of states, the rules they've implemented, the way that works is you get a step up in basis. So it doesn't matter what the basis of your parents is. They pass and step it up to you. It is now basis to you equal to the fair market value of that asset upon their death. So let's say they bought it for $300,000. They fully depreciated it. 42 years later, they pass and you inherit that property. It's now worth $1.5 million to you, even though they only paid $200 for it, right? And even though they might have taken depreciation on it, it is worth $1.5 million to you in basis. Okay, so this means a couple super important things. It means there's a depreciable basis potential there for investment property. It also means, and this is very important, the best time to sell inherited real estate, if you don't want to continue to manage real estate, is as soon as you inherit it and, within a short time frame of that. Because now, if you get it, by definition, your basis is the value that roughly you'll receive when you sell, which means what? Very little taxable gain. We've learned in past episodes of the tax plan, capital gains are calculated on the sale price of an asset minus the basis in that asset. So if our basis is the fair market value and we sell soon after inheriting it, well, we're going to get roughly the fair market value because it hasn't had time to appreciate or depreciate over time yet, right? And I should probably use a different word because I'm not talking about tax depreciation now. I mean actually the value going up or down in that real estate asset. So that's a really important concept to understand. If you inherit real estate and you don't want to, manage rental properties, which a lot of people don't, very soon after the inheritance finalizes, maybe there's probate, whatever, when it's yours and it's totally yours, if you are in a step-up basis state, it's time to sell if you don't want to maintain that asset. And then that full value, maybe you move it over into a brokerage account. Maybe you move some here, some there. Whatever your investment strategy is, if you want out of being a real estate manager, even passively, selling it as soon after inheriting it as possible is best. And let me just add a caveat to as soon as possible. There might be states who have certain rules of like a 60-day holding period before it can be sold. I don't know what states that would be. So let me just say, since listeners can be anywhere, you should know the rules of your state, talk to a professional about any extra intricacies, but generally as able to, as you are to the date of inheritance, if you are in a step-up basis state is the best for you tax-wise, okay? And we've already kind of touched on just kind of in general, how are the sales of homes taxed? And that's their capital gain. So understand also that even when you do have capital gains where what you receive is higher than your basis, just understand that it is at the lower, assuming you've had it for over a year, the long-term capital basis rate. And so that's the other thing to consider, is that some states consider any sale of inherited assets as long-term, regardless of how long the decedent owned it before passing it on to you. Some states, you need to hold it for a year. I actually don't know if that's the case, but just understand that there are different rules for the timing, not only in the basis when you inherit an asset, but how long you're in practice considered to have held it. Remember, you always want long-term capital gains rates on the sale of assets. So make sure that you're in a step-up state where your basis is the fair market value upon the decedent's passing. And then make sure it also gets stepped up in the context of it is considered a long-term capital asset for you, based on the rules of inheritances in your state. Okay, so the main non-inheritance consideration, you're selling your house is if it's your primary residence. And the way the IRS looks at that is it is considered your primary residence if you've lived in it for 2 or more of the last 5 years. So this is the number one way to just not pay taxes on real estate. The exclusion is $250,000 currently in 2024 for single filers and $500,000, for married filing joint filers. Okay, so what this means is I bought a house in 2019. Good for me. Great timing. I sell in 2024. Housing market is doing pretty good right now. I bought it for $1 million. It's now 1.7. I would only pay taxes on $200,000 of a long-term capital gain. So I get $1.7 million from the sale. I pay, let's just assume I'm in the highest tax bracket, which means I pay 20% on long-term capital gains. I'm paying, what's 20% of $200,000? 40 grand. Okay. So that's pretty good. That's not a lot of taxes for a home sale. Now I buy a new home. We live there for 4 years. We sell. I can exclude up to $500,000 again with my wife, or $250,000 if I'm single. So that's the simplest and also the most advantageous. So some people do that, like they're into real estate investing, and part of what that looks like for them is they move into a house, they fix it up, and then they sell after 2 years because they've met the threshold. And now, even if they've done a ton of renovations and the home itself has appreciated in value, they get to deduct the entire capital gain as long as it's under that $500,000. And not only do you not have to pay taxes, you don't even have to report it. So you don't have to report home sales where the capital gain, meaning sale minus basis, is less than that either $250,000 or $500,000. So that's a huge thing to understand and take advantage of. Let's now get into, as we get into the last part of this episode, the complexities of different options for real estate. And these are all assuming real estate as investments, because for your primary residence, there is nothing better than deducting $500,000 from the potential taxability. That's the best as it gets. Okay. So let's talk about investment as real estate, which means it's not your primary home. And so you got to worry about tax considerations, potentially very high, because as a real estate investment property, you've been taking depreciation. So your basis is even lower than the value you've paid, because remember, we arrive at the basis of what our kind of ownership basis in that asset is by what we paid minus depreciation taken. Okay. So there's a couple options we're going to talk about. The biggest one that you might have heard of, you might hear a lot of people kind of talk about in sound bites. It's a very popular thing, and that's called a 1031 exchange. So what is a 1031 exchange? It is the exchange or transfer of like kind business property. That means I have a family residence that I've been renting out for 5 years. I don't like that area anymore. I want to get real estate investments in an area that I just moved to so that I can manage it myself. I don't want to have to be paying handymen across the country. I want to be hands-on. You can do a 1031 exchange, and there's a couple considerations. First of all, what does that mean for you? A 1031 exchange, if you meet all of the requirements, means that you do not pay any capital gains taxes on the sale of your property. So that's what it means. A successful, we'll call it 1031 exchange, means you don't pay taxes on the capital gain. Here are those requirements. It has to be for like-kind property, meaning you can't sell your investment property and then buy a personal residence, okay? So it has to be investment property to investment property, rental to rental, okay? The second requirement, and we'll just kind of group all these together, is there are various timing requirements. So you have to identify the property being exchanged within 90 days, and then you have to actually finish that purchase or sale in 180 days. So what that means tangibly is I'm selling my rental property. I sell it. I have 45 days. Almost always this is done through like a third party who specializes in this and can record keep for you. So you record with them. Here is the address of the property I'm going to buy. That has to be done within 90 days. This is the replacement property. Then you have to buy that property within 180 days of the closing date of the home that you sold. Okay, so identify in 90 days, complete within 180 days, and it goes backwards. So you can also do a legitimate 1031 by buying a property and then identifying, because some people have multiple investment properties, right? Identifying within 90 days which of their properties are they going to sell to 1031 exchange into what they just bought, okay? And then they have 180 days to sell that property they currently own and complete the 1031 exchange of old property to new property. So because the timing requirements, and let me tell you, they're very strict. You have to meet these to be eligible, okay? It can't be 189 days. You will not qualify and you will pay capital gains taxes, okay? IRS is very strict about 1031 exchanges. So what that means is usually people have already started putting their home out and have already identified a replacement sale so that they're not cutting it close here. I'm going to buy this home. I've already talked to the owner. We've agreed on a price. My home's currently up for sale. Awesome. As soon as I close on my current home, I'm going to give you the money, and we've already kind of figured it out, and the whole thing happens in 30 to 60 days, and there's no risk that we meet one of those two requirements. Then there are numerous value requirements. So to avoid capital gains, and I won't get into the complexity of what happens if you don't fully pass this, there is some gain and it's prorated based on the percentage differences of values, and we won't get into that. But for a successful 1031 exchange, what it means is you need to put all of the cash received into the new property, and the new value of the property needs to be greater than or equal to your current property. So if I have a $1.5 million condo and I have $750,000 left on my mortgage, so I'm going to get $750,000 when I sell. I have to get a property that I both put at least $750,000 down on, and the second requirement in this value consideration, it has to be worth at least $1.5 million. Okay, so those are the two value propositions. So there's timing to consider. You got to make sure that it's investment to investment. You can't do this with your personal home. And then there are valuations to consider. So generally, 1031 exchanges are a more aggressive strategy for younger investors, because as you can kind of see, the trajectory of a lifetime of 1031 exchanges is you're usually not going to go exactly 1.5 million to 1.5 million, which means you're generally, because the value has to be at or greater than your existing property, people are usually increasing the value of their real estate through 1031 exchanges. Okay, so it is more of kind of an aggressive strategy. And then you can keep doing this. I have this new property worth 1.8 million that I own for 7 years, and then I 1031 exchange down the road into another property that's worth 2.1 million, and I can keep going. And the kind of colloquialism, if you will, of 1031 exchanges is I'm completely, it's similar to like shop till you drop. I'm totally blanking on like the synonym for exchange that they use, but it's basically just, I think it's swap till you drop. That's the terminology. So there's a couple of considerations for this. Obviously, after a lifetime of kind of increasing value of your investments through a bunch of 1031 exchanges where you're constantly upsizing, you don't want to eventually just sell it all or downside and then pay a massive amount of capital gains taxes that you've been kind of deferring your whole lifetime. And then the second reason that this swap till you drop colloquialism is true is that, let's remember our initial discussion where we talked about step up in basis. So one of the main reasons people do 1031 exchanges is the deferred gain dies with you. So if I've been doing 1031 exchanges my whole life, I started with 1.5 million from my parents, I continually am upgrading. By the time I die, I have $10 million in real estate. I pass that on to my son. He doesn't pay taxes on any of that deferred capital gains. He gets it with a step-up basis, and he now has a $10 million basis in investable real estate. Okay, so huge incentive for long-term strategies to 1031 exchange, constantly make little upsizing moves to continue to 1031 exchange into more and more valuable property, swap until I drop, and then eventually die, and my inheritors get a step up in basis, and no one ever pays capital gains taxes because I kept deferring it through successful 1031s, and then they get a step up so they don't have to worry about it, and there's never taxes paid on that deferred gain. As you can see, pretty powerful strategy here. There's one other thing I really want to talk about, which is a DST, and that's called a Delaware Statutory Trust. And this is super relevant. A lot of people don't know about this, okay? This is something we've recently been kind of researching more because it answers this kind of issue. Well, I want to do 1031. Like, I don't want to just sell my house and be out of real estate and pay capital gains and put it in the market. For a lot of people, that makes sense. Some people want to stay in real estate, but you can see the trajectory of a 1031 action. You kind of have to keep doing it, right? And then every time you do it, it's got to be greater value or equal value. So it's kind of a continued momentum move. And some people don't want to continually have higher and higher stakes investments, and then eventually you've got a mortgage on a $2 million property that you've still continued to put just like $750 from our initial example here. And now you're in $5 million of valued real estate and the market tanks 20%. And now you can't pay your mortgage because you can't find borrowers, right? So you can see how the strategy is aggressive. It does come with risks, let me tell you, okay? Because we won't get into a whole market versus real estate comparison here. The biggest difference, though, in risk tolerance is when the market crashes for real estate, assuming mortgaged real estate, right? Leveraged real estate, there's a debt component. When the market goes down, there's much larger risk. The only thing you can lose in stocks is the value of the stocks, right? The only thing that can happen is that it tanks. If you can't pay your mortgage, you start losing cash flow. You might have to liquidate the property for lower than the value you put into it. You might need to make a payment if you lose a house because of, bankruptcy at the bottom of the market. So leveraged investments, debt-fueled investments, they're always going to come with slightly higher risk in that regard. So some people don't want that component. So a Delaware Statutory Trust is a type of real estate investment vehicle. Biggest consideration here is it can be 1031 into, and basically you get trust ownership units in a managed portfolio or a collection of assets. So it's similar to any real estate investors that are familiar with the term REITs, which is a more kind of exchange traded or publicly traded real estate investment vehicle. DSTs give you that same sort of totally passive ownership. Someone else is managing it. It's an entire portfolio. They're professionals. I don't need to worry about handymen and commissions on a real estate manager and filling vacancies when people move out. But you can still stay in real estate and get generally market rates on real estate, rents and appreciation. So this is a really cool tool, and you should talk to a professional. There's nothing I can tell you in this episode that you can just by yourself just go DST your property tomorrow or make a 1031 into a DST. It's not going to happen, but it is a super important concept to understand. If you want to make real estate investment decisions, it's a great way to maintain your market value in real estate investments, stay in the real estate market, but drastically reduce your activity and your management in that investment vehicle. And for a lot of people, it also reduces risk because you can be in a DST that potentially has a very diversified portfolio where rather than just 1031ing into larger and larger condos, you can 1031 into an interest in a DST whose philosophy is we are 25% single family residents, 25% multifamily residents, 25% commercial industrial, 25% commercial retail, right? And so they have a very diversified portfolio. So there can be lots of benefits of this strategy. And then the greatest one is it doesn't end your 1031 journey. So generally DSTs and REITs have end dates where there's kind of like a target date of what we want to accomplish. And then theoretically there's an eventual sale of the real estate. And so then in addition to all the cash flow that you've received year over year, you then also get, your share of the initial, of the end sale price, similar to selling your own real estate, where you bought in at this value and they sell all the real estate in that specific DST portfolio, and then you get your share of that sale. So there's the appreciation element, in addition to the dividend, so to speak, of rental income that you're receiving from the DST, which would be subject to capital gains tax in a similar way of investing in the stock of a company that appreciates. You sell the stock and it appreciated, and now it's worth more than what you paid for it. So there's that similar element as well. So, but this leaves you open to then doing a 1031 exchange before the end date of the fund and just continuing to get back into active real estate, or just into a new DST that has a longer time horizon because they just started. So this doesn't like terminate your ability to engage in 1031 transfers. You can keep that option open, and you can continually 1031 in or out of DSTs in the same way that you can your own real estate investment property that you personally own in terms of individual properties. Okay, so there's lots of cool things. It is a complicated topic. When you get to that road, you'll want a professional, get someone that you can trust. Know what commission you're paying, know what fees there are involved, see the not that future performance is guaranteed by past performance, but you will want to analyze the historical performance of various portfolios, what have been traditionally the risks, or, to use an investment term, the beta, which measures variability and volatility. What's the beta of this investment? Is it more volatile than a different portfolio that this company has? Or, no, I'm going to go with this other DST company. I feel like their portfolios are a little bit more, grounded, a little bit less risky, and I'm okay earning, 1% less on average for having less volatility. So there's lots of considerations in the same way that you make any other investment decision, but there's a lot of benefits of this path, and it's just a cool thing that a lot of people don't know about that can be a very powerful tool. There's one last thing I'll talk about, and I won't really get into it. If you want to be in a REIT, okay, which is a real estate investment trust, and the benefit to these, to be very simple here in this discussion, is greater liquidity. They're often exchange traded. You can often sell into REITs in a brokerage account. Your advisor can often trade in or out of REITs in the same way that they can stocks. So they're often seen as significantly more liquid assets than DST. Your options to 1031 out of, or even sell your interest in a DST, you are in the secondary market technically. You're not trading on the New York Stock Exchange. So you do have to find a buyer. Now, there are DSTs with hundreds of billions of dollars in real estate, and there are plenty of people who are happy to buy your interest. And there's oftentimes not a significant liquidity issue with DSTs, but REITs definitely have larger liquidity and can be traded more easily. So here's the big downside of REITs. And so just understand there is something called a 721, which sort of acts as a 1031 exchange and ultimately allows you a similar situation where you can transfer your real estate investment property into interests in a REIT. I won't go into the details of how that exchange works. Just understand that this terminates 1031 eligibility. You can't 1031 out of a REIT. Okay, so once you're in a public real estate investment trust, when it ends and it liquidates and you get your capital gain, you're done. So you're going to pay capital gains now on that gain. You can't swap till you drop with this situation. Okay, so that's the main reason a lot of people are hesitant to do this. It can be a great way to again, you inherit property, right? You have the basis, you 721 into a REIT. It appreciates a little bit. You pay a very moderate amount of capital gains taxes. And now the REIT has reached its target end. It liquidates. You've gotten a little bit of dividends over the course of those couple years. You then have a capital gain. You get your money back. It was 1.5 when you got it. It's now 1.65. You pay, on that gain, maybe you pay $20,000 in capital gains taxes. And now you've got $1.65 million that you can invest however you want. So it's not an illegitimate investing strategy. Just understand, if you're on this train where you like this 1031 strategy, you kind of like the DST option, the REIT 721 exchange is a permanent decision. You can't 1031 anymore. So at that point, the funds in the REIT will eventually not be in a REIT anymore, and now you've just got investable assets, and you're out of the real estate protection system where you can potentially keep deferring capital gains through 1031 exchanges. You've kind of ended that option for yourself. Okay, so well, that is certainly enough, I think, for this episode. Look, this channel is called 15 Minutes of Finance. I never said mine would be 15 minutes. Okay. I didn't say I'll talk to you about the market for 15 minutes. So the tax plan will occasionally be longer. I don't want to give short, brief advice that doesn't understand the options. So it's a lot. There's a lot of options. A lot of this is not something you'll go and just do yourself quickly. And in the case of any form of 1031 exchange, and this is something I actually should have talked about. So let me just add one last thing for you at the end here. You cannot ever touch the money. It immediately invalidates your 1031 exchange. This is a super important concept. You cannot touch the money. If I sell a house and then I identify the one that I want to buy, and then I sell my house and it's in 90 days, and then I buy the new house within 180 days, but the money from the sale of my existing house was deposited into my bank account for 12 hours before transferring, I have invalidated my 1031 and I'm going to have to pay capital gains taxes. It is that strict. So a 1031 exchange always uses a qualified third party. So the sale of the house, the money has to go to the third party who holds it for you until you buy the new one, and then they pay the new sale price for you for the new property. You cannot take the money in your custodianship or your ownership of the sale of the property you sold. You can't do it. Very, very strict. So I'm glad I remembered that at the end, because it's the least flexible of any. Not that any of these rules are flexible. The 90-day rule, not flexible. 180-day rule, not flexible. The fair market value rules, not flexible. But just understand that people, they're like, oh no, I didn't ever like spend the money. It was in a separate savings account, and then I immediately paid the new seller for the property I bought. It doesn't matter. If it's in any account of your custodianship and you ever functionally have control of the money, boom, sale or 1031 exchange eligibility invalidated. So very, very important concept to understand. So as a quick recap, if it's your personal residence, $250,000 or $500,000, just straight deduction. There's no thought process there. You just get it. So if your gain is under those limits, sick. There's no taxes. As simple as it gets. If you have real estate that's an investment vehicle, very important to consider your options before just selling a house. It might be advantageous to 1031 exchange into a different property. It could be nice to 1031 exchange into a DST and be in a real estate portfolio being managed by a professional. You might even want the option of going the 721 exchange route and then getting into a publicly traded vehicle that gives you further liquidity and ultimately gets you out of real estate and into now more flexible liquid funds where you can invest however you like. And then we also talked about a very important concept, and this is going to apply to a lot of our listeners. There's going to be a lot of inheritances over these next couple years, the next from now to the next 20, 25 years. If you inherit property, make sure you know if you're in a step-up basis state, and make sure you understand the timing of it. Is it immediately considered a long-term asset for you, or do you have to wait a year after receiving it to sell it and receive long-term capital gains favorable rates? Very important concept for you to understand. I hope you guys enjoyed this episode. It's a little bit dense, but it's very thorough, and I think in terms of the few tax plan episodes we've done so far, it probably gives you the most tangible, practical picture of these concepts that we've talked about, and gives you really a lot of options if you are considering, selling real estate. And again, make sure you get the advice of a professional for your situation. These things can be very complicated, and they're very great, powerful tax planning tools, but you don't want to do something wrong and then end up paying taxes that you thought were getting deferred because you didn't meet all of the various requirements. So make sure a professional that you trust is helping you that can understand the complexity and convey that for you to make sure you understand all of the rules involved in the steps that you're taking. As always, we appreciate anybody who subscribes and listens every week. We also appreciate any questions or comments or suggestions for future episodes so that we can answer the things that our viewers want to hear answered and learn about. So hope you enjoyed yourself, and we'll see you next time on The Tax Plan.